All right, look at the Asian markets. They're doing okay, not too bad on tenterhooks ahead of the decision coming in from the US Fed. However, again, the Japanese index down by about 0.1%. But if you take a look at the Korean index, that one's moving higher by about 0.5%. Along with that, we're seeing mild greens coming in, both Straits as well as Taiwanese indices. Remember, yesterday, in the United States, the markets did move higher from the lows, a near 0.6-0.7% recovery seen on the Dow. The Japanese index, of course, in focus ahead of the two-day Bank of Japan policy meeting, which starts today. So expectations out there. However, the SGX Nifty outperforming the other Asian indices, up about 1/3%. This after the monster rally that we've seen over the last 6 trading sessions on the Nifty of almost 600 points. And today's uptick can perhaps be attributed not only to the positive sentiment that we're seeing in the world, but the decline that we're seeing in crude prices. And like Anisha said, maybe some more liquidity coming into our markets.
Okay, so mixed cues coming in from Asia, but more or less positive. And on Wall Street, the US markets closed higher after a very volatile session. Now, the S&P 500 closed just above its 2018 low in the green, but the Dow Jones moved around 80 points higher. This after erasing its 300-point rally earlier in this session. And the Nasdaq managed to hold on to gains of almost 0.5%. CNBC's Deirdre Bosa gets us a wrap of all that transpired on Wall Street yesterday.
U.S. stocks slightly higher today, the Dow adding 82 points, the S&P flat, and the Nasdaq up 30. Single-family home construction tumbling more than 13% year over year, according to the U.S. Census. Building permits, an indicator of future construction, also falling about 2%. This comes after home builder sentiment plunged to its lowest level in over 3 years. Meanwhile, oil prices continuing to slide, dropping under $47 a barrel to a 15-month low as the U.S. and Russia continue to pump oil at record rates. It is the second straight day of declines for the oil market, with prices shedding 7% today. Oil prices falling sharply over recent months amid analyst warnings of slowing demand in the market. And last-minute shoppers, beware. The clock is ticking if you're looking to make sure your gifts are delivered in time for the Christmas holiday next week. Today is the last day for guaranteed standard shipping from many of the nation's leading retailers like Kohl's, Nordstrom, and Gap. But don't fret too much. You do have a bit more time if you're looking to shop online at Walmart, Target, Amazon, or Macy's. That's the action from the U.S. market. Back over to you in Mumbai.
Absolutely. Thanks a lot for that. In fact, Anisha, if you're looking to buy anything from the US which needs to be shipped by 25th December, do it today.
I just don't think I can afford anything, and anything will get delivered to India at least in time.
Or you'll have to pay less because
at least, yeah, that's the good news today, right?
Okay, so on that note, let's also hear out some opinion coming in from Alex Dryden of JP Morgan Asset Management on what's leading to the volatility and the triggers going ahead for the US markets.
Volatility that we've been seeing creeping into the financial markets that came in really around the beginning of October has really been triggered by the fact that the TINA trade has died. Now, TINA, just for the viewers, stands for there is no alternative, and it's been the supporting trade of this equity bull run, that investors had nowhere to go but stocks. Now what we've seen is that the risk-adjusted returns in the bond market are starting to look a little bit better, and investors are beginning to rotate. There is now an alternative, and investors are looking to take that. Move out of equities, reallocate to bonds. We're late in the cycle. Investors are putting a little bit of bubble wrap into their portfolios as protection, just in case we hit a bump in the road down the line in 2019. We're also seeing some opportunities in the international markets, particularly in emerging markets. Emerging markets have had a tough 2018. The dollar has been to blame for a lot of that, but we do believe, looking out over the next few years, the dollar will begin to weaken. That'll take a lot of pressure off emerging markets. Investors who have got in there at today's very attractive valuation levels, we think could be rewarded for taking that risk in the long run.
Okay, and US President Donald Trump has warned the Federal Reserve against a rate hike. Now, Trump referred to a Wall Street Journal opinion piece published and titled "Time for a Fed Pause" to drive home his point. He tweeted, and I quote, "I hope the people over at the Fed will read today's Wall Street Journal editorial before they make yet another mistake. Also, don't let the market become any more illiquid than it already is. Stop with the 50 Bs, feel the market, Don't just go by meaningless numbers. Good luck, end quote. Trump's 50 Bs may refer to the Fed's current policy of reducing its bond holdings by a maximum of $50 billion per month. His tweet came hours before the Fed starts a two-day meeting at which it's widely expected to raise the interest rates.
All right, so what exactly could the reasons be for the recent sell-off in the American markets? What are the factors that spooked Wall Street, and what is the Fed expected to do after its two-day policy meeting, along with the noise that there is, which is coming in from the political arena? With that, we have Steve Leisman, who joins us with all the findings of the CNBC survey. Steve?
We wanted to know the question of what really is bugging the market. So we put a bunch of things out there: tariff concerns, weak global economies, the Fed hiking rates. And we said, has this contributed a lot, somewhat, or not at all to the recent market sell-off? And 71% said tariffs were a lot. This does not add up to 100, because you could any percentage could answer for each one of these questions, right? Global weakness is in the number 2 spot of contributing a lot to the sell-off, followed by the Fed and more rate hikes here. Earnings, and then look at the last position here. The least concern of all, the least contributor to the sell-off is weaker U.S. growth. So what do these guys think? This is a survey of 43 economists, strategists, and fund managers. 63% say the market is projecting too pessimistic an outlook for earnings and the economy in the next year. Just 27% say the market has a too right, and only 7% say it's too optimistic, meaning there's more to go. So now take a look at the forecast here. And these guys they follow the market up and then they follow it down. This is a pretty big drop. 2774 is the estimate for the S&P 500 for 2019, followed by 2836 for 2020. But look, we've had this sell-off here, so there's still 7% upside for next year if you go to this number here. Now, I want to show you the outlook for bond yields and tell you why that's important. Not because these guys are right. Notice they were looking for a 3.5% 10-year yield by the end of 2019 through most of this past year here, and now they've come way down. It's not important what they think. What's important here is the amount of easing that is now in the mind of the market. They were looking for 3.5%. Now they're only looking for just above 3%, and the current 10-year yield is just north of 2.80. Okay, let me show you the top line results before we go here. Pretty good percentage now looking for a rate hike in December, 98%, and that's up from our November survey. But look at what's happened. Again, the easing in the mind of the market, fewer rate hikes. 1.8 is now the average of those, which tells you that pretty much everybody agrees on 1, and then more agreement towards 2. But look at what it was. It was a debate between 2 or 3, and now that debate has shifted, and looking for less than 1 hike in 2020. All of this is online, all the results, if you want to see some of the commentary and some of the detailed results. But ultimately, we're looking for a hike tomorrow, and then for the Fed, those forecasts of the Fed to come down for 2019 and beyond.
Okay, thank you, Steve, for that. So the expectations of rate hikes in 2019 has come down from in between 2 or 3 to 1 and 2 now. So interesting developments there. But here is some opinion from PIMCO and UBS on what to expect from Fed in the policy meet today.
Expect the Fed to be highly independent and do what it thinks is right for the U.S. economy. What it thinks is right this week will be a rate hike. But after 3 years of interest rate hikes, the Fed clearly is getting signals about where neutral is in terms of its policy rate, and it's getting closer to a pause, and markets then might be able to breathe a sigh of relief in 2019.
Last thing they want to do is put themselves back in a box on saying when they would hike again, because I felt like the Chairman Powell kind of put the Fed into a box in October with statements that were more hawkish than the market liked. And they should get back to the data-dependent message, and that would really help the markets.
All right, so what will the Fed do? Will it be a dovish hike, a hawkish pause, or anything out of the box? Well, all of that, you don't have to wait for too long. 11:30 p.m., that is where it starts. You can watch it extensively on CNBC TV 18. With that, we go across to the European markets. They've ended lower amid escalating concerns about a slowing global economy. And remember, the European markets ended when the US markets were at the low point of the day. So that is an important factor that affected the closure of the European markets at the low point of the day. 1% shaved off FTSE, about 1% of the CAC, and the DAX sitting slightly outperforming with a cut of just about 1/3%. In individual stocks, Britain's Indivior, that surged towards the top of the European benchmark on Tuesday. The drug maker announced that it would sell a cheaper version of its opioid addiction treatment drug while maintaining its full-year profit and revenue forecast. Let's see whether there is an impact of that on one of the Indian pharmaceutical companies or not. That stock was higher by about 18%.
Okay, on that note, let's shift the focus to the currency space because the dollar hovers around one-week low levels ahead of the Federal Reserve decision, persistent market volatility and a wide expectation that Fed will slow the pace of interest rate hikes going forward, leading to a weakness in the greenback. Keep an eye on the Indian rupee as well because that one saw the biggest appreciation in a day in over 5 years yesterday.
In the world of commodities, crude oil prices plunge on oversupply concerns. US and Russia continue to pump at record levels ahead of the planned output cut by OPEC and its allies. Brent hovers around the lowest since October 2017. NYMEX too falls to a near 16-month low.